Hey everyone, what if I told you that what's happening in the stock market should impact when you file for Social Security benefits? Well, in today's video, I'm going to show you how sequence of returns risk can be mitigated with filing for Social Security, and I want to walk through a few real examples that's going to challenge conventional wisdom some, but by the end, I think you'll see why filing early for some people could be a smart way to protect your future. Now first, I want to make it very clear that I am not a fan of making long-term decisions based on short-term movements in the market. But the simple fact is that your retirement income plan needs to be agile and evolve as things change. And picking the right time to file for Social Security is certainly a big part of that retirement income plan. And this is where the sequence of returns risk comes in. If you were planning to wait until later to file for Social Security and you have negative returns in the first few years of your retirement, the data shows that filing earlier could help you escape some of that damage caused by those negative returns. And I know this doesn't agree with what a lot of the experts are saying about filing for Social Security, because you don't have to do much research on the right age to file to come across a lot of articles that say filing as late as you possibly can is the best strategy. And in the vast majority of cases, the financial media and the experts behind those articles paint with really broad brushes. Their belief is that in the majority of cases, age 70 is the best age to file. So what's the thinking behind this recommendation, and how is 70 the clear winner in most cases? Why do they all seem to say this? Well, most of this advice is because Social Security decisions are typically considered in their own silo and not as part of the big picture. So when you consider Social Security on its own and not how that filing decision should change based on your decision about Roth conversions, the order in which you're going to withdraw funds from your accounts, and a number of other decisions, there's just no way that you can really come to an optimal decision when you only consider that on its own. And unfortunately, none of the retirement planning software programs out there that I know of, at least, consider this comprehensively, and we've tried almost all of them. Instead, in the background, they do a simple break-even analysis based on the age you put in that you think you're going to die. And based on that, they'll tell you the optimal age to file. And 9 times out of 10, it's going to be 70. And you're also going to see this in the programs that offer Monte Carlo testing to give you a probability of success. Usually, you'll see that the probability of success will be higher if you choose to file later. So, for example, here's a screenshot of one of the largest financial planning software companies, and with everything else being equal, filing at 62 has an 80% probability of success, and filing at 70 has a 90% probability of success. Now look, it's very unfortunate that it works out this way, but I can't tell you how many financial advisors make their recommendations to clients based on whichever scenario gives the highest probability of success number. Now, that brings up the whole issue with relying too heavily on financial planning software to make decisions for you, because all of this software is hyper-focused on the finish line. How can you get to the end of your life with the highest balance in your accounts? And that's not the way you want to make these important decisions. Much of this is because these software programs are all geared to make recommendations around answering the question, will you run out of money in retirement? Now, I certainly think that's an important question that you need to get answered as a frontline test. But once you've satisfied the fact that your money is going to last, it's time to start ignoring some of the recommendations of the software and look at the data and make these decisions for yourself. Now, I could go on for a long time about that part, but I know in this video I have to stay focused and talk about how to find the right age to file for Social Security. So let's get started on giving you the information you need to tune out some of the noise and make a decision that's really optimal. So before we jump into how to use Social Security to help insulate against the sequence of returns risk, I want to make sure that we're all on the same page about what the sequence of returns risk actually is. So to illustrate this, I'll use a story that I often use in my online workshops. So Bill and David worked together at the same company for 30 years. Now, they'd both told each other that when they got to $1 million, they were going to retire. Now, Bill had been saving a little bit more than David, and he finally hit his $1 million goal at the end of 1996. And just like he had promised, he turned in his notice, and December 31st, 1996 was his last day. Now, he figured that with the returns he'd been getting, he would just stay invested in all stocks, and that should allow him to get 5% of his account value as a distribution, and he should be able to increase that by 3% every year to account for inflation. So that's what he did. Now, his friend David wasn't at the $1 million mark yet, and he was determined to wait until he got there before he retired. And in 1999, thanks to the strong market performance that we had, David hit that $1 million mark, and he turned in his notice. So December 31st, 1999 was his last day. So we talked to Bill about his strategy, and Bill said that, I'm just taking out 5%, and that's working out great. In fact, I've been able to increase that, and today I have more money in my account than I did when I retired. So David thought, well, it's working out great for Bill. I'll just do the same thing. And for Bill, the guy who retired in 1997, that strategy did work out great. He had some up years and some down years in the market, but it always seemed to come back and leave him with more money than he had before. But that's not the experience that David had. The first 3 years of his retirement were bad years. And with the combination of negative markets and his distributions from those accounts, he saw a 50% decline after the first 3 years. And by the time he was 81, he was out of money. Now, in that same year, his friend, who had followed the exact same strategy, had more money than what he had started retirement with. And this is the risk of the negative sequence of returns. And, market returns are much like a card game. You just never know how the deck is going to be dealt. And if you have several years of negative returns at the beginning of retirement, it can be damaging. But there are some steps that you can take to give you some protection against this risk. And having a strategic Social Security filing strategy is one of these steps. So let me give you an example of a couple that we work with and how we help them decide when they should file for Social Security. So this is Rob and Corey, not their real picture. They were both 62 years old. They had just retired, and after calculating their expenses and adding in some travel, they decided they'd like to get $10,000 per month in net income. So $10,000 a month hitting their bank account. In savings, they had $1.9 million in their pre-tax accounts, so their 401ks and IRAs all combined, just over $400,000 in their joint brokerage account, and between both of them, they had about $75,000 in their Roth IRAs. Now, their income streams were fairly average. One of them had a full retirement age Social Security benefit of $3,300, and the other had a $2,000 full retirement age benefit, but they also had a $900 pension. Now, they didn't want to get too fancy with their income modeling for the future. They just wanted to get the $10,000 per month, increase it by 3% per year, and then they took our recommendation to cut that at age 80 and then have another cut at age 90. And in the last 2 years of retirement, they allocated a big chunk of income to pay for their long-term care. So one of the big decisions they had in front of them was, when should they file for Social Security? Now, they'd both been reading everything they could get their hands on about this, and they knew that basically they had three big options with a lot of little options in between there. They could file early at 62, they could file late at 70, or they could do a split strategy like their advisor had recommended, and the lower earner could file at 62, and the higher earner could wait until 70. Now, they wanted to play it safe and test lots of different scenarios. And one of those was to test against a negative sequence of returns. So we modeled out, what if we had the same returns that we did from the beginning of 2000 to the end of 2023 with a portfolio that was 60% in stocks and 40% in bonds. And I think this is the ultimate negative sequence of returns. 3 years of negative returns right at the beginning of retirement. Now, 2000 to 2023 is only 24 years of data, and we were planning their retirement for 34 years, so we had to average those years out and apply that average just to the back-end years. But that's not a big issue because we mostly wanted to test those first years of retirement. Now, when we are doing planning from a big-picture overview, we want to look at how does this action, whether that's filing for Social Security, Roth conversions, distribution sequences, or whatever it is, how does that affect your account balances and cumulative taxes? So let's take a look at Rob and Corey here and see how this would have worked out for them. And I want to show all three of these scenarios at once. The orange line on the bottom is their account balance if they'd filed at 70. The blue line is if they'd used the split strategy where the lower earner filed at 62 and the higher earner filed at 70. And the green line at the top is if they'd filed for benefits at 62. Now, it becomes apparent pretty quickly that filing at 62 helped them to protect their account balances because they weren't taking as much in distributions when the markets were going down. In fact, the scenario where they filed earlier helped them keep a higher account balance all the way out until age 94. Now, I know these are just numbers on a chart about something that happened in the past, but I can tell you, I was practicing as a financial advisor for most of those years on that chart. And the difference for someone having an extra $400,000 on average in their accounts would have given a lot of peace of mind. So based on how your account balances would have reacted, it seems clear that at 62, filing would have worked out best. But what about taxes? Well, when we look at the cumulative taxes they would have had to pay, you can see that filing early resulted in lower cumulative taxes than either of the other strategies. And this is mostly because the taxable income wasn't as high because the distributions from the pre-tax accounts were lower. So in this case, with the return sequence, filing early would have resulted in a higher account balance and lower taxes. So that leaves the big question here. Is filing early best for most people? No. There's no way that we can take this data set that we've used here and imply that. This is going to change based on your age, your income need, the amount you have saved, where you have that saved, the account types. But I don't think filing early should be discarded completely. Instead, you need to test, and test some more. You need to look at all the filing ages and how they fit different withdrawal strategies and Roth conversions. You need to stress test your portfolio against negative market returns and early death of a spouse and several other factors too. But just don't accept the plan that gives you the highest probability of success. And don't just accept the word of someone who has paid for a subscription to a financial planning software. Because I can tell you this, no one is going to feel the pain of retirement mistakes like you will, so you have to get clarity. You know, your plan shouldn't be overly simplistic, but it should be very clear. Because I can tell you from the 20 plus years that I've walked this road with people like you that without clarity, there's no confidence. You can't afford to go any further down the road of retirement without complete 100% confidence that your strategy is going to work. And that doesn't mean that you need to hire me or any other financial planner to tell you exactly what you should do. You know, I'm a big believer that retirement planning is one half data, one half how you feel about that data, those emotions. And ultimately, to get there, though, you have to have data that is presented clearly and then determine how you feel about that data. This is the only way you can get the retirement confidence you need. And I can promise you that if you look at enough scenarios, if you look at enough data that's clear, you can find the plan that has the right balance that works for you and your family. Now, this is something that my team and I can help you with. We can show you how your Social Security filing age, withdrawal strategy, and potential Roth conversions all fit together under the umbrella of tax efficiency and maximizing your retirement savings. You know, we'll get deep, but our finished output is going to be data that is instantly understandable and gives you clarity. You're going to know how the combination of Social Security filing ages, withdrawal sequences, and Roth conversions are going to impact your overall balances throughout time and be able to quickly see the tax efficiency of each one. So if you want to find out more, you're welcome to book a retirement clarity meeting with me. There's going to be a link down in the description where you can find out more about that process. But you know, regardless of if you use me, do it yourself, or use another financial planner, I do wish you a very long and prosperous retirement. Thanks for watching.